Welcome to Maple Leaf Money, a nation-building initiative dedicated to making financial literacy accessible, objective, and empowering for all Canadians. In every episode, we bring you lessons, ideas, and stories that strengthen individuals, families, and our collective financial future. Today, we're continuing our look at everyday banking by talking about something most of us use constantly, but rarely stop to think about: bank accounts. Checking accounts, savings accounts, student accounts, even things like joint accounts or business accounts. We hear these terms all the time, but if no one ever explains them clearly, it's easy to feel like you're just guessing your way through the system. So today, I want to explain bank accounts the way you might explain them to someone sitting across the table from you. Calmly, clearly, and without jargon. At the most basic level, bank accounts exist to help you organize your money. If all your money sits in one place, it's hard to tell what's meant for bills, what's available to spend, and what you're trying to save for the future. Accounts allow you to separate money by purpose, and that separation alone reduces stress for a lot of people. Think of accounts as containers. Each one has a job. Let's start with the one most people already have: the checking account. Your checking account is where everyday money lives. It's the account money flows through. This is where your paycheck usually lands. It's the account you use to pay rent or a mortgage, buy groceries, tap your debit card, send e-transfers, or withdraw cash from an ATM. Because money moves in and out so frequently, checking accounts usually don't earn much interest. And that's completely normal. They're designed for access and convenience, not growth. So, if your checking account isn't making money, it's not broken. It's just doing its job. Now, contrast that with a savings account. A savings account is meant for money you don't need right away. People often use savings accounts for emergency funds, short-term goals, or simply to keep money out of reach of everyday spending. Because that money is sitting there instead of being spent, the bank usually pays you interest. And just to be clear, earning interest simply means this: the bank pays you a small amount of money for letting them hold your savings. It's usually calculated as a percentage of your balance and paid monthly. The amounts might seem small at first, but over time, interest rewards patience and consistency. A common habit that works really well is automatically moving money from checking into savings. Even something modest, like $50 a month. That habit builds both a financial cushion and confidence. You might also hear about high-interest savings accounts. These are very similar to regular savings accounts, but they pay a higher interest rate. People often use them for emergency funds or short-term savings because they help money grow a little faster while still being relatively accessible. Some of these accounts come with conditions, like being online only or limiting how often you can withdraw, but once you understand the rules, they're straightforward tools. Now, let's talk briefly about student and youth accounts, because this is an area where people can unknowingly overpay. Many banks and credit unions in Canada offer accounts specifically designed for students and young people. These accounts are often no fee, meaning there's no monthly charge while someone is learning how to manage money. The key is knowing these options exist and choosing a bank or credit union that offers them, which is actually very common. This is a great example of how understanding the system can save real money. You may also hear about other account types as life changes. A joint account is simply an account shared by two people, often partners or family members, where both names are on the account and both can access the money. A business account is used for self-employment or business activity. It keeps business income and expenses separate from personal money, which makes tracking, budgeting, and taxes much easier. These accounts aren't complicated, they just exist for specific situations. One area that's important to understand, but often overlooked, is fees. Some accounts charge monthly fees, others charge per transaction, meaning you might pay a small fee every time you make a purchase, send a transfer, or withdraw cash beyond a certain limit. This is why it's important to review an account's fee schedule. That's simply the document that explains what the account charges for and when. Fees aren't automatically bad, but they should never be a surprise. Many people can reduce or avoid them by choosing the right account, maintaining a minimum balance, using student plans, or banking through a credit union. Again, clarity creates control. Before we wrap up, there's one habit worth reinforcing. When spending money and savings money live in the same account, it's easy to blur the lines and dip into money you meant to protect. Separating accounts makes progress visible and decisions easier. It's a small structural change that reduces stress and strengthens discipline over time. Here's today's closing reflection. Bank accounts aren't about complexity, they're about clarity. Checking accounts help money move. Savings accounts help money wait. When each account has a clear purpose, and when you understand things like interest, fees, and account types, managing money becomes calmer and more confident. Strong financial habits don't start with advanced strategies. They start with understanding the simple tools you use every day. Thanks for listening to Maple Leaf Money. Subscribe on Substack or wherever you get your podcasts, and join the movement to build stronger financial literacy across Canada. Until next time, stay informed, stay steady, and keep growing.